Hello, everybody, and welcome. As we like to do every week, we like to take a look at the past week's market activity and then kind of bounce around the market and look for something to trade. This week, we're going to learn a new technique, so stick around, put on your helmets. This is going to be probably pretty complicated, but you can watch this a few times and hopefully it'll start to sink in. But anyways, let's look at the market first. Over the last few weeks, you've been watching. It's obviously been taking a bit of a dive, which means volatility has increased, which is good. As volatility-based traders, we love this. So this is the S&P 500. The NASDAQ is going to look fairly similar, not as extreme. You can see it hasn't gone just straight down. It's kind of bottomed out there. But again, same thing. Volatility is pretty high, which is nice. IWM's taken the biggest beating. As you can see, it's pretty much near its lows of the year. And again, volatility is high. But really what's taken a beating this last few months, if you've been watching, is the bond market. This is the bonds. And these things have been collapsing pretty much all year. And you can see volatility, therefore, is through the roof. This is probably the highest the volatility has been in a few years. So obviously bonds is where we want to get into. Now normally what we do as contrarians is look to make a trade that is going to assume that over time this thing's going to hopefully bottom out and start to turn around as contrarians, right? This could go down forever, not forever, but it could go down for a long time. But at some point we have to make an assumption, and that's the assumption as a contrarian I'm going to make. I'm going to say, hey, this has been bottoming out for months. Hopefully, when I make this trade, this is very near the bottom. It'll start to turn around over the next 40-ish days. And the way we would do that normally is just sell a put vertical. I'm going to use a different platform here because I have to make a couple of points to really drive this home. So if we were selling put verticals, what we would do is the stock is right there at 84.79. We'd start by selling the put just below the stock price. We're going to make this a $2 wide put vertical by buying the put $2 below that. And as long as we collect 66 to 80 cents for this trade, it's valid. Great. All that we already know. So here's a couple things I want to point out on this particular trade. And remember these as we go to the newer trade so you can kind of compare. And you can go back and forth if you need to. Number one, the POP on this trade is 57%, meaning it's better than the 50-50 shot. This is not a coin toss. Roughly 60% chance of making money. The other thing is when we work out profits and losses on this trade, the most we can make is $70 or 70 cents, because as we know, the most we can make on any trade is what we sell it for, which means we're risking $130. So we can lose potentially $130 if things go wrong. We can make roughly we can make $70 if everything goes right, and the chance of making money is about 60%. We go 57. So risking more to make less always means our POP is above 50, and it is. So remember these numbers. We can lose 130, we can make 70, and there's a 57% chance we do that. So now I'm going to go instead and create what's called an unbalanced iron condor. So I'm going to move the vertical to the exact same place, 84 and 82, but I'm also going to sell a call vertical above the market. And I'm making the call vertical $1 wide as opposed to 2. So this is a $2 wide vertical. This now is just a $1 wide call vertical. So why would I do anything like this? Well, number one is I collect more money. So if I have a strong assumption that the market's going to bottom out here and start to turn around, I might sell the vertical. But maybe I want to try and collect more money by doing that. And the way I would do that is also to sell the call side, right? Because you can see I made the same vertical, but by selling the call side, I'm now collecting almost 30 cents more by doing that. But what happens? My POP has gone way down. And why is that? Well, it's because now, in simple terms, I can make $96, but I'm only risking 104. So remember before I was risking 130 to make 70? The more you risk compared to the less you make, your POP is going to go up. In this case, I'm risking about the same to make about the same, and so my POP went way down. Again, why would I do this? Because I'm risking a little bit less, but I can make a little bit more. But when we talk about risk, I talk about risk as in what are my chances of being successful? So even though I'm only risking $104 here, where I was risking 130 before, and you might say, hey Cal, I'm risking more to make less. That's a riskier trade. It actually isn't, because this has a much lower chance of being successful. So I know I can lose more money in the end and I can make more money in the end if I'm right, but there's just a smaller chance that this will actually succeed. Okay, hopefully you get that point. But here's what we're going to do. When I say unbalanced iron condor, this is a dollar wide. So if I can collect at least $1 or more over here, there is zero risk to the upside, meaning if I'm wrong and the stock shoots up to 120 in the next 40 days, normally an iron condor, if it blows through your call side, you start losing money. In this case, I won't, because if I collect $1 or more, this is a dollar wide vertical, so there'd be no risk to the upside is the way they say it. I know, again, this is very complicated. You might need to watch this a few times, but I like to introduce new concepts. So I want you to watch now this POP. It's 29%. Watch what happens when I raise my potential credit up above $1. Now right here at $1, if this thing shoots to the upside, I lose no money to the upside. So my POP is still the same as far as making money, but my chances of losing money are a lot less because I don't have to worry about the call side. But if I go just to 101, watch the POP here, it goes up a full 10%. And that only means that if it goes to the upside, my probability of profit means my chance of making at least $1 at expiration, well, this is $1. If it breaks through my call side, I still make that $1. So my POP went way up. So what are we trying to do here in the end? Just to put it in simple terms. We're trying to make sure that this trade collects at least the width of the strikes on the smaller side. Because if it's $1 or more, I can't lose to the upside. And therefore my POP actually went up significantly. I know it says 29, but it's essentially 39. I can't lose to the upside if I collect $1 or more. $2 wide put vertical, $1 wide call vertical. So let's just say tomorrow we can actually make this happen. And everything stays exactly the same, and I make this trade and I collect at least $1. Then I can make $100 on this trade, and I can lose $100 on this trade. And again, that is why we would do something like this. It seems less risky because I'm only risking $100 to make $100, but because my POP is so low, it's actually a riskier trade. But this again is being more aggressive. If you're more aggressive and you want to try and make more money because you think your assumption is going to be correct, on the vertical I can make 70. On this iron condor I can make 100 if it stays below my calls. And even if it blows through the call side, I don't lose any money. That's the key. So that's what they call an unbalanced iron condor. I know, confusing. You might need to go back and watch this a few times to really absorb it. But again, that's why we do a trade like this, and that would be our trade for tomorrow. So if I go to the trade page, I've set this up already. This is what it looks like on the platform we always see. It's a $1 wide. We'll change it so you can see it. It's the $2 wide vertical on the put side, meaning we expect it to go up over time. And we're selling the call vertical. It's $1 wide because we want to try and collect more money, make it a little bit riskier trade, and hopefully it stays between these two strikes, the 84 and the 89, and we can collect a lot more money. But again, the trade-off is the chance of making money is less. But we're not going to make this trade unless we can collect at least $1, because then there is no risk to having the call side on for our iron condor. If it goes all the way up to the moon, we don't lose any money. And if it stays below 89, we can potentially make a lot more money. So that is an unbalanced iron condor. Assuming everything stays the same tomorrow in TLT, that is the trade we will put on. I am excited to let you know I've completed a book that is now available to everyone that wants to get it, called Learn to Trade in 7 Days. This is a book that will take you from absolute ground zero, as far as knowing absolutely nothing about options, all the way to trading them. Now, I'm so intent on getting this book to you because I really believe it is such a valuable resource for anybody and everybody. that I'm going to offer an incredible deal on this, so stick with me on this. But before we get there, I want to show you what the book entails. The book is broken down into 7 days. Day 1 being what is an option. You'll learn everything about options themselves. We'll compare stocks versus options. Then we'll get into basic option strategies like the vertical. And finally, we'll wrap it up with how to trade verticals and then the making and managing of trades, which is to me the key to success long term above all. Now, as I mentioned, if you get into it now, if you go to this link, you can get this book for only $9.99. And I know that may not appeal to a lot of people because a lot of people aren't into books, but I'm so intent on getting you this book because I really believe it is such a valuable resource to anybody and everybody that I'll also throw in any one of my courses right here available on Udemy right now. So for only $9.99, you not only get the book itself, but you get one free course, which can be valued for as much as $100 depending on when and where you buy these courses. Again, just go to this link here and it'll take you to this page where, as you can see, you'll get the book and one of my courses for only $9.99. So really can't be beat. So again, just to reiterate, go to this link here. You will get my book, which you can hang on to forever, and I really believe is such a vital resource. I'm throwing in a course to really get you motivated to buy this book. That's how important I really believe this book is. The book and one of my courses for only $9.99 simply by going to this link. Please jump on this opportunity. It is something you really will be happy you did.